The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Now, the author of The Path of Least Resistance and the Tech Insider, David White.
And welcome to another wonderful edition of the Power Trading Hour with your humble but lovable host, David White. And we've got kind of an interesting day shaping up out here, and we'll kind of figure out how this is going to sort out. But not unforeseen when we saw, about a little over 4 billion shares to the upside yesterday compared to the 5.4 billion shares we saw on the huge mark down the day before. So, we'll have to see how this works out. Anyway, wanted to go right to the indexes and some of the stocks that are having the weaker part of this day. Let me update my charts here just a second. But we're looking at the S&P cash out here at 1552.41. It's gotten as low as 1543.69. I suspect that we're probably going to see a little bit of pressure later in the day, but this is pretty much where they want the indexes to expire, and we're probably going to start seeing some stocks move on options expiration, and we'll get to Apple in just a second. One of the things we did have, if you missed it, was a mini flash crash in, it says untitled. Anyway, we had a mini flash crash in Europe. It came very close to the same time that we found out that there were 70,000 new unemployed people in the United Kingdom last week, and it was very interesting, to say the least, that we are, how can I say this, seeing Europe go down the tubes. It is in recession. It has been in recession for probably, 2-3 months. You can continue to put fingers in the dike, but eventually the holes will overwhelm the boat and start filling it. That's what we're starting to see now. China, of course, came out with numbers. No big water pump out there to bail out the boat. And we're getting into the part where it's extremely diminishing returns in the United States. That was fairly evident. What it was going to be that broke this market is unclear, other than just on its own weight instead of one particular piece of news. Of course, it really started with the China news. We started seeing the markets that were highly fragile start to bust, first in gold, and now we're starting to see crude down a couple of bucks today. And what else are we going to see next? Well, I suspect it is the S&P. We've got weakness down to 1475. May not see that until next week. I suspect that we are going to see, and I'll probably see it this afternoon, some massive buys in the option market. We've already had some huge moves in the option market. In fact, it looks like from the tape that there was one buyer of puts in the IWM that had the equivalent of 3 million shares short, and they went ahead and flipped those over into Mays. So instead of taking some money off the table, they basically just swapped them out and rolled them over today. One of the hugest buys in IWM options ever. Let's take a quick look at IWM here. IWM. And while we're picking that up, actually pretty good. We're going to, we broke through there with higher volume a couple of days ago, the bounce, but we are coming back down, setting up a move in the IWM, probably the gap around 84 to 86.25. That gap happened on pretty high volume, which will be a support on, what do we have here? On the 31st of January. Well, what was that? Actually, on the 2nd of January, the second and third, that huge gap, and that's where I suspect the entire market is going, and in a hurry, not probably going to be waiting around for too many people to catch up. What will probably happen, though, is we will see the market try to hold up through the end of this week. This 1550 area is a major mark for the option market makers. If they can hold this thing out, they're going to make a lot of money on both sides of the puts and calls as a enormous, one of the highest rates of options goes expired. Now, we did talk about the FXI. That is another one that saw massive put buying in there today, FXI, into May. So people are buying some huge downside surprises. This stock already hugely down, and into what will be a gap area and support area, but everybody's really starting to freak out. The iShares FTSE China 25 index is the FXI, if you're just listening, and pretty decent volume back down. It really looks like this thing's going to blow out, though, and go back down to the high 31s, 32 area that we saw last year in the September 5th lows, the July 12th lows, the June 25th lows. They're all in that area, June 4th lows, which is pretty much the level of support. Many people kept on buying the idea that China had just was growing huge, and they were buying lots of iron ore. Just even last week, I was hearing all the brouhaha. There was very little to support that whole issue. There's actually a lot more anecdotal evidence to suggest that China is starting to see some bank pressure, and maybe this is what we'll find out next week, that actually a lot of those empty cities are starting to roll over and find huge amounts of sellers instead of the buy that everybody just had. I got a cream. Okay. Anyway, just wanted to look at some other things. Anyway, we looked at those two stocks. Of course, the ones that most people are wanting to look at today are Apple and then Bank of America. We'll go look at Apple. We thought that with a 75% of the trade going against it, Apple looked fairly decent. But even that being said, 25%, which is the stock being down on very light volume, was problematic. And we were looking for somewhere in that 396 area. Got down to 398.11. I think it's, what is it trading out here at now? Let me look real quick. 403.62 is the last quote I see on that. We're going to probably see that close, I suspect, under $400 at the end of the day, and probably about 395. I suspect that you see that they've been doing an excellent job of pinning this on expiration, and it looks to me like they're trying to set this up for an expiration price of $400 on Friday's close. There are a huge amount of 400 calls, and I suspect that is what is afoot, at least partially. There are two major issues that are affecting Apple today. A lot of people are blaming the suppliers in the supply chain of lower volumes. That is, I think, one part of it. Probably the bigger part that most people haven't heard is the move by Facebook to heavily push the employees away from Apple products and into Android products all over the campus at Facebook. They have a lot of charts showing the growth of Android and the kind of spiral down of Apple. And I think that whole Facebook home thing that they're pushing as a wrapper to all of Android's operating system is something they're desperately going to go after. And there was a little talk about going and putting this Android home on Apple, but I suspect it is going to be cursory between the two. Apple's no way is their culture going to allow somebody to come in and dictate them how the stuff works. who they buy their music from. Apple is a closed system and will live and die by it. For those people that remember my call back on September 28th of last year when all the suppliers were looking pretty horrible with the exception of a couple. Those were, I think, Qualcomm and one other. But the rest of them that were majorly wrapped around Apple's supply chain were looking horrific when Apple was printing a 705. And I warned everybody at that time to really start watching Apple. I thought it had probably come close to its zenith. All this chart didn't really give you a good sell signal out there. All the supply around Apple, the suppliers around Apple were giving a pretty clear and a signal that that entire part of the segment was problematic. Apple itself has one big problem, and that is margins. It still has double the margins or more than Samsung, sometimes triple the margins. The question is how long will the cell providers continue to pay the premium for Apple products to get Apple customers? My guess is that it's going to get more and more difficult over the next 6 months. And we've already seen the stock price pretty much forecast that. What I wanted to do actually is get back into the expansions on this thing, because there is a 1-to-1 ABC that sets up right here. Hopefully you can all see it. Maybe someone will tell me in the den. But there was a 1-to-1 ABC off that top where the let me zoom in here just a little bit so everybody can see just a little better. As we hit that 705.07 high from September 21st and came down, that is your A point from September 25th. Your B point came at 505.75, and your C point came in on December 3rd at 594.59. That set up a 1-to-1 ABC. Let me take this out so we can see it just a little bit better, actually. So we can show. There we go. You know, we'll have a little bounce in this thing, but that's pretty much, we've gotten within, 3 points of the 1-to-1 projection in Apple. Could it get worse? Maybe. My guess is this thing's probably going to expire somewhere around $400 on Friday. It's probably given up most of its energy already in the last day here with it getting to this level. Volume has picked up, but as long as it stays below about 45 million, I suspect you're probably going to have a decent buy out here in this, at least a short-term rally out of it, while the rest of the market probably continues to move down. We'll be back in just a few minutes. Again, this is David White with the Power Trading Hour.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
This segment is brought to you by Goldfields. For more information, just click the Goldfields banner on the front page of TFNN.com.
As we come back, had a question in, and that is, what do I see going on out here? And I think this is options expiration. We had a lot of people way on the wrong side, highly irrationally exuberant in this marketplace. The options were telling the correct story. I said there was last Thursday a 96% chance that we would get back plus or minus 10 points to around that 15 to 50, 15, 55 level. And it is rare that people are so far out on one side of the market that it doesn't at least come back. The old story is the reversion to the mean. Now, it doesn't always do that, but it was very rare to find both the front month, this month, and May, both showing about 15, 50, 15, 55 as the center point where the most people would lose the most amount of money in options if it expired here. Now, could we see lower 1540, something like that? It is not uncommon to see the weekly lows and the weekly highs on Wednesdays as we go into expiration and then the week of expiration. A lot of times you'll get a little bounce on Thursday on down months during expiration, and then it closed probably right back here. Right now, looking at the volume, which is significant. Let's see if I got up here to right. Yeah, that's right. Just looking to make sure these things are working well. 3 billion shares already means that we're probably going to be into that $5 billion range by the end of the day. Suggests we're probably going to see some selling into the day. Now, normally, and this is going to get on a bigger rant, but what happens sometimes is when markets start to move very quickly, options charts tend to not be worth a whole lot. The idea is that we have irrational actors in the market, and normally when the heat isn't up real high, people can make some fairly decent decisions. When the heat does get very high, people make emotional decisions instead of rational ones, and you see markets really move like we saw today in Europe. I see a lot of the instability in the market, and it is not uncommon to see markets break without any chart signals in markets where it is as, how can I say, it's just ready for an avalanche. We've had a huge amount of money thrown into the system. That money is probably, from Bernanke, is probably made this system incredibly brittle and not resilient. And it is going to be easy to find things like flash crashes, runs on stocks, a lot of this kind of stuff coming around. Now, normally, as a betting man, I would say there's probably a 20% chance that we see a lot further down before Friday. My guess is that we're probably going to see something like 1540, 1550 expiration on Friday, that we're going to probably see a little bounce on Monday, and then the selling in earnest is going to come along. We're finding, and if you're watching options, we're seeing massive put buying, and this isn't by Ma and Pa kettle. This is people buying 500, 1,000 puts. I think we're probably going to see a lot of that reported on television tonight. And the big guys of Wall Street are throwing their money behind and at least buying some decent downside protection. Like we said, probably the biggest buy ever in two indexes, the IYM and the FXI today, are going to be big indicators that the people in the street are wanting a lot of downside protection in this marketplace. That the IWM came down, and 3 million shares, pretty good chunk in the IWM. That they just rolled those options over makes me think that they are more than confident in their position, and it's probably a big street name that bought those options. Not me. I didn't buy those equivalent of 3 million shares worth of options. Of course, each option the equivalent of 100 shares. So take off 2 zeros on that for the amount of options, but still huge. And when we look at the 5.3 million shares that were shorted on the FXI, or the equivalent with those options, gives you a good idea. But 80% chance we probably don't do anything. One of the things we need to talk about, though, is how markets get brittle. And we'll talk about that when we come back on the other side of the break. You can always email me at pat@pfnn.com if you have a question you'd like me to answer before the end of the show.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Baby, let me be your love teddy bear. Put a chain around my neck and lead me anywhere. Let me be, let him be, oh, teddy bear.
And if I could just reach out and choke Steve, the engineer/producer, and I guess he thinks that that will be my theme song if he just plays it enough. We've got Bank of America off about 5.5%. Apple's off almost $22 at 404.46. We've got the Dow off 129, 130, and S&P off 20, almost 22. I suspect that we're probably going to see a little bit of selling into the closeout here, and you might see a little bit of pop tomorrow. And I suspect a close back into that 1550, 1540 area. We've had a major movement in the marketplace, and most people that have not been through crashes or, and I mean big movements in the market, like 1998, the dot-com crash. I'm going to say that the 2007, 2008. Was more orderly, and you had a lot more time to figure out what was going on. It was longer, and it wasn't as violent as the previous ones we saw in 98 because of long-term capital management and the dot-com craze. It was wicked vicious every day. So if you're thinking the other day where we had a 30-point move, just figure what a 50 or 60 point move would be with intraday rallies that are 30 points higher in the S&P, coming back, movements in the 80 point, 90 point range, plus or minus a day in the NASDAQ. It was just incredibly wild and vicious in 2001. Same kind of thing that we saw in 98 in October with the long-term capital management. In fact, we were at the boiling point for the entire market in October of 98. There's some great books about it, and they're well worth reading if you want to become a professional trader. But one of them is called Paving Wall Street. There's some other ones about, if you just do an Amazon search, you're going to find a lot of books about long-term capital management. And they're probably well worth reading because they are about the smartest people in the room doing stupid things. A lot of times people talk very eloquently on the CNBC or Bloomberg TV, and they sound good, so you must believe them. But it's not just how people talk, but what they know. When I remember about the people that were the best callers of the dot-com bust, was that they're not allowed much on CNBC anymore. If they were right back then, no one wanted to know about them. And I'm trying to remember the guy's name that made the best call of all of them. I'm trying to remember Fleshman. It'll come to me in a little bit. Anyway, this guy was absolutely spot on with his call. I think anybody that didn't have blinders on could have seen the coming crash of the NASDAQ with stocks that were basically making no money with 2,000 and 3,000 PEs, and they were already losing money. So that was actually why it was a lot more violent. Today we have a market that is a bubble, but the stocks aren't worthless underneath it. But the problem is that they have been hyperinflated by Bernanke, and that sets up a market that is brittle, that can break. Nassim Taleb has a new book out on how to make robust systems that can endure shocks to the system. Now, what we had in Boston, a pretty minor event compared to 9/11. But we've had, this is kind of like a mini 9/11. We had some people killed. We had some poison sent through the mail. At least that's what everybody's saying. But, it is systems that are easy to break. And I'll give you an example of this. When I was learning to fly, the plane that they had me in was a Cessna 150. And even back in 1986, I think the thing was built 26 years earlier, something like that. So anyway, my instructor would get me into impossible situations where the plane was just looked like there was no way to get out of it crashing. And he told me, just take your hands off the wheel, your feet off the rudders, and just sit back. And the plane would pretty much self-right itself. If you let it alone long enough, it might have crashed. Nose would still be going down. But as it went down, it would pick up speed. You'd get more lift on the wings. The nose would start coming up. In fact, if you really don't know what to do, probably the best thing in those planes is just take your hands off the wheel, and it will probably self-right itself. Now, let's go on to a few years later, 1960, the Cessna 150 technology, and I think it's about 1976 or 78, the F-16 Eagles came online. They were designed to be totally unstable. A actual pilot, if there were wires going to all the control surfaces, could have never flown the plane. The little computers in there were 3 of them, would move the surfaces about 100 times a minute to make sure that the plane was stable in flight. As long as 2 of the 3 computers on board agreed with themselves, then nothing would, the plane would fly itself. If only 2 or only one of the computers, or basically none of them agreed with each other, there was an automatic system to fire the pilot right out of the cockpit because with one computer and out of 3, basically the idea was that there was no way that the one, which computer are you going to pick that's right to sit there and flutter those controls. It is a system that is dynamically unstable. And most of the time, stock markets or even planes are fairly stable. But they can get to that point where they are hugely unstable. And that Cessna, there are places and ways that you can get it into it where it is going to fail. It's going to stall. Most of the time you can get out of them. There are a few things like ice on the wings that make it, where you can't fly it at all. My point here is that there are very unstable systems, and we see them in airplanes and things that man manufactures. We also see them in things like snow avalanches. I think I've told the story a few times before, but the first time I went skiing in Colorado, to that point I had only skied down a mountain of coal dust that had built up over about 40 years, and they made it into a ski run. It was about maybe 3/8 of a mile long, but it was enough. I went up there every weekend for about 8 weeks, Saturday and Sunday at nights, and got good enough that I didn't feel bad about going out to Colorado with a couple of my buddies. We went right up to the top of the mountain at Breckenridge, and I saw 5 people get off the lift. They ran right underneath the yellow warning tape and started running up and up the mountain in the out-of-bounds range. Well, we went down the hill. We came back up just about the time these guys had climbed almost all the way to the pinnacle. And there was kind of a little curvy thing off the top of the mountain where the snow had blown over on the top. And the first guy got up to that top, got on it, was going to hop off and go straight down the hill. Well, he did. Unfortunately, that started an avalanche that killed his next 6 buddies. And I kind of figured out right then that skiing was pretty fun. I didn't need to go up there and cause an avalanche that would possibly kill me or others. But unstable systems are easily to get started, and I suspect that because of Bernanke, that's exactly what we have, a brittle market, a market that has real instability, and we're seeing it today in things like gold. Crude's off $2 today. That we can't find a bid in these commodities makes me suspect there's a lot of bad news, and I suspect it's coming out of China. We're probably going to start seeing some instability there. We already have that whole issue with Europe in a recession already. The 70,000 new unemployed people in the United Kingdom today, or at least that's what the numbers said, probably are really catching up from the last 2 or 3 weeks where they underreported them. But the signs are that the market and the world economy is ready to pull back, regardless of how much Bernanke throws at the problem. It's not going to make companies make any more money. So can he get the price-earnings ratio up? Yes. Can he get the earnings ratio, the actual earnings number up? The answer is no. And I think he and the others are probably well aware of the problem they're in. That is that he can probably keep the worst of the bubble from bursting. These stocks are not worth nothing. But I suspect that he's run the market up a good 15 to 20% higher than the market should be from the underlying fundamentals. We were talking about Bank of America, and I wanted to get to that chart. These banks and, of course, the housing market had looked fairly weak before, that we could not hold that last high in Bank of America on March 19th. It had decent volume, 240 million shares, which was great over that. Should have been able to hold that, but it pulled back in under that 1220 and 1242, the previous highs from January 7th and February 13th. Were critical in probably putting in a high in these banking stocks. We saw the housing stocks also weak. We talked about those yesterday. As you start putting together the big plan out here, it looks very much like we've seen a top in the marketplace. I went short, and like I said, I put on 4 new short positions, mostly in puts, while the VIX was at its lowest, and a lot of those are doing extremely well. In fact, what do I have here? I've got one that I bought at 75 cents, I think 75 or 80 cents in the energy sector, and let me get the current quote on this thing here just to see. It's printing off 265, 275. About 2 or 3 times a year, you're going to be able to buy puts and get that kind of huge return on your money. So what is it, 75, $150, 225, so 200%, closing in on 300%. And I suspect we've got a lot farther to go. I'm looking for probably somewhere between 7 to 10 times my money on options. Now, the idea on options, before anybody gets the wrong idea, is to always know that options are a way to reduce risk, not add more risk on. If you were going to buy 100 shares or sell 100 shares of a particular stock, then you should buy one contract if you were just buying the underlying. The idea is just because options are a lot cheaper, you don't load yourself into one position on a particular stock more than you would if you were buying the underlying index itself. So just repeat after me. Options are not a way to add risk. They're a way to reduce risk. And normally you want to buy options on very, very expensive stocks because the implied risk to the downside with puts on, buying, at least in game theory, you'd want to buy calls on very inexpensive stocks. If you have a $2 stock that goes to $10, a lot more likely than a $500 stock going to $2,500. It is the law of big numbers, and you want to be, most of the time, you'll figure it out, that it is worth buying puts on very expensive stocks and stocks that are going to move high relative to their implied underlying volatility. In this case, I got into the energy put for that reason alone. Its underlying was somewhere around $43 at the time, and that it moves $4 is great. But a couple $3 more down is going to give me a huge profit in this thing and everything I was looking for. I've got some puts on some other high-flying stocks. They have not cracked yet so far, but the implied volatility in $200 and $300 stocks is huge. If I can get a 30 or 40-point move, I'm going to get exactly the same kind of return that we saw in the energy sector. And again, a lot of these high-flying stocks out here are the belief is that they won't go down with the rest of the market. And I suspect that a lot of these stocks that are extremely high have extremely high priced earnings, and they will not be handled well when the earnings come out here in a few weeks. Let's see. Yeah, Bill Fleckenstein. I want to thank, is it Borare? I don't know how to pronounce it in the den. B-O-R-A-R-E, Borare. Okay? Well, whatever it is. Bill Fleckenstein, pretty much not allowed on CNBC anymore because he was rather vocal in saying, Borare, okay? He was pretty vocal in that 2000-2001 range in telling everybody how full of it they were. There was a constant gaggle of talking heads on CNBC basically saying there was no end to the upside in those .com stocks. He was one of the few voices out there. I still see him around from time to time, but I think he made so much money there, you really didn't have to see him after that. We'll be back in a minute and catch up at the end of the hour here.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
The last hour of trading in the day, and that is to start looking at the volumes and seeing whether they are picking up or not. Last time we checked in, there were about 3 billion shares. We've had about 10% more, coming in at 3.3 billion today. I suspect that we're going to have a lot of volume at the 3:30 hour. Could this market just break and technicals be damned? The answer is yes. We've seen the flash crash in Europe this morning. The system is brittle. In a standard day without the kind of volume we've seen, I'd say, yeah, there was probably a 90% chance we close at 1550. We could break this thing and there'd be no end to it. Is that likelihood high? The answer is probably about 20%. I think 80% chance we close out somewhere around this 1540, 1560 range, probably on Friday. And then we're going to have options rollover. Options rollover is Monday and Tuesday normally. After it, they try to push the market up a little, they try to push the market down a little, and they roll over and put in new options in the market, of course, weekly. But the ones I'm really more interested in are the monthlies, and we go out. We've seen these huge buying today. We'll see probably a lot of news about it tonight, and I'll be very interested to see what the smart money does the last 30 minutes of the day. But it doesn't look to me like there's a whole lot out here that is making me want to think that there's going to be a rally in this market anytime soon. There was a question in the den, should I hang on to my position? I suspect that we've got at least 45 to 90 days of a market pullback, and I suspect that me getting out of my options here when I bought them at a ridiculously low price because of the VIX and the implied volatility means that this is one of the times, probably the one, maybe two times this year, I'm going to be able to be making massive amounts of money, not by being smart and thinking a lot more about this, but basically sitting on my hands and letting the money come back in. I'll wait for a big signal to get out of these, and most of my puts are into May, but I suspect we're going to have some kind of rally. I'll probably close out of those puts. The options will then be way too expensive to play, and I'll go back to picking out individual stocks to go longer. But like I said, there's a couple of stocks I'm at that are in the higher price range. One's off 2.5%, another one's off a couple of percent today. So not a bad market out here. They're going to try to hold these up at least into Friday. That's why I went out to May. I wasn't looking for short money. I was looking for longer money. But all we have to do is look at some of these especially the ETFs. The tech sector had been the worst performing part of the market. The TECS, which is a tech ETF, is up 6.5% as we speak. IBM just couldn't hold the 214, 215, 215 highs. It's back in the 209s. IBM is a good example of a stock that will try to pin, and I suspect they're going to try to pin this thing out at 210 on Friday. It's still one of the bluest of the blue chips, and, of course, they'll probably swing in and buy a bunch of shares to hold this thing up. The problem is that it's not near the size of Apple. Apple probably going to get down into, I would imagine, 380, and maybe they'll try to pop it up to 400 and expire it there on Friday. So probably not a lot of money to be made in these really large stocks, but I suspect we're going to see those start really pulling back into next week, Monday, Tuesday, when this option rollover starts. So hang on to your hat, buckle in. We'll see you tomorrow between 2 and 3 for the Power Trading Hour. This is David White signing off. Same bat channel, same bat time.